The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to Nova 401k Associates webinar. I failed my ADP test. What can I do for 2020? This will be presented today by Steve Vest. Steve is the Vice President and shareholder here at Nova. If you have any questions throughout the presentation, please type them in the questions box, and Steve will get those answered throughout the presentation. Also, if you would like to receive CPA credit today, please make sure that you have registered individually for this webinar. You remain on the session for the entire time, and then in 1 week, a certificate will be emailed to you. Also, a PDF version of today's webinar will be sent out after the webinar is over, so you do not have to request that information. Again, that PDF will automatically be provided. Steve, we are ready to go.
All right, well, good afternoon, everyone. Welcome to this webinar. Again, we sent out invitations to specifically the plans that did fail their average deferral percentage tests for 2019. So all of you probably had that issue or should have. First, a quick disclaimer, we're just giving general information in this webinar, and it's not intended to be substituted for legal or tax advice. If you have, need that kind of advice, please consult either an attorney or accountant who can legally supply that. Also, if you need CPA credit, our provider number is 009820. You need to have registered individually, be present for the entire webinar, return the evaluation form you get at the end of this webinar, and then you'll get a certification form within a week. So on the agenda today, a little introduction as to what the average deferral percentage test is. How do we usually cure or solve these types of testing problems? Some other solutions in terms of how you can either get out of the test by being a safe harbor plan, or perhaps do some mid-year testing to give yourself a better idea of how you're doing in the current year, and then what kind of plan amendments and or testing elections might be needed or changed depending on how you might want to modify your plan based on what we tell you in this presentation. So again, our learning objectives are to understand what is this ADP test and how are the refunds applied. Again, give you some other options that you might be able to implement to minimize the refunds that are associated with this type of testing failure. And then other types of plan designs that are available if you'd like to consider them and possibly solve the testing problems by doing a plan design change. I always like to start with some of the roles and responsibilities here. Again, all of our clients, the model that we're having for service is what we call an unbundled arrangement. Typically, there are 4 distinct roles that have to be played by different entities for any 401k plan. We've got the plan sponsor, which is your company. Your company has overall fiduciary responsibility for the plan, and your primary responsibilities include getting employees' payroll deductions into your payroll system, offering your employees the plans based on the waiting period on time, and then getting those contributions from your general ledger and payroll over to your investment provider, which is down in the bottom left quadrant. Again, you do need an investment provider to provide the mutual funds. They're going to provide the 1-800 number, internet access, and they are the ones that actually are the custodian of the money. The money never comes to us, the TPA, or your financial advisor. So Nova functions strictly in the compliance area. We don't handle any of the money. We can get involved in some of the loan and distribution review for you, but at the end of the day, it's your company that's approving those types of loans and distributions, or even signing refund forms, for example, that are associated with these testing failures. So we handle all the compliance from the IRS and the Department of Labor, like preparing your Form 5500 annual filing, preparing these tests that we're going to talk about today, maintaining your legal plan document, amending it whenever necessary. And then the fourth leg is your financial advisor. You know, NOVA as a TPA or your investment advisor, whether it's John Hancock or Mass Mutual, Voya, and, you know, whoever we're partnering with, you know, with your company. Our firms cannot give specific investment advice to your participants. So, you know, obviously general educational material can be given to them, but if they have specific questions about what investments they should be utilizing or need help constructing their portfolios, that's where the financial advisor comes into play. And then also they can help you with coordinating enrollment meetings. And so these are the four different roles and responsibilities for any 401k arrangement. So 401k plans are really heavily regulated by the IRS and the Department of Labor. And this is because the plans do get preferential tax treatment. You know, the company gets a tax deduction for any employer contributions that they're making on your company tax return. The individuals are getting to deduct their employee contributions on a pre-tax basis from their pay. And so because of these tax benefits, they're quite regulated by these two entities. And also part of their job is to protect the employees in the plan as well. Some terminology, we'll be abbreviating quite a few terms in the webinar today. Just wanted to go through a few of these items here. We've got HCE, which is going to stand for highly compensated employee, and we'll go through, you know, what does that mean? NHCE is for non-highly compensated employee. ADP stands for the average deferral percentage test, which we'll be talking quite a bit about today. And then QNEC stands for qualified non-elective employer contribution. And essentially, this is a type of very specific employer contribution that can be made on occasion to help pass the average deferral percentage test. We'll go through some of the details of that as well. So there are actually 5 to 6 different non-discrimination tests that NOVA runs for you on an annual basis and that all 401k plans are generally subject to. We're not going to really be dealing with the bottom 4 here. We're going to be focusing on the ADP and the ACP test. But just so you know, there are quite a few non-discrimination tests that the IRS requires be run on all 401k plans. And all of them to some extent are measuring different forms of discrimination. What they're all going to look at is the primary overriding concern from the IRS is that the highly paid individuals or the highly compensated individuals in the plan are not benefiting disproportionately more than the non-highly compensated employees. Each of these tests kind of measures a different component, but the idea is the same. The IRS wants the plan to be fair to both categories of employees, both highly and non-highly, and whenever the plan isn't being fair, in their opinion, then there's some sort of corrective action that needs to be taken. So again, we're just going to be talking about the average deferral percentage test today. So one of the most common questions we do get here in NOVA, and a lot of times these come in from participants, highly compensated participants, who will tell us that they've done some research and they know that they can put in the full 19,500 based on some internet searches they've done, and they don't understand why they can't put that much into the plan. Well, the reason they cannot is because the plan is subject to this average deferral percentage test, and it's generally a participation test. Okay, so it's going to look at and make sure that the plan does not discriminate in favor of the highly compensated employees with regards to the deferral percentages, the contribution rates that they are putting in versus the non-highly compensated employees. Okay, and failing this test requires some corrective action. The most common one that is taken is to refund some money back to the highly compensated employees. But there are some other options. They do end up costing the employer money to implement them. And so we don't see them used as often, but the employer can decide to put in additional employer contributions, which are then counted as employee contributions for purposes of this participation test, and can help it pass. Or there can be a combination of refunds and QNEX. So there are some options, but again, QNEX are an employer contribution, which cost the company more, and are not usually utilized for that reason because the companies don't really want to put in any more money. So there are several steps to actually performing the ADP test. The very first one is going to be to determine which employees are actually in this test. All right. So the employees in the test are going to include all of your eligible employees for a particular plan year. Okay, it's going to include people that participated and contributed. It's also going to include the people that were eligible but chose not to contribute. And it'll also include people that terminated during the year. So if you had an employee who got a W-2 for 2019 and was eligible to be in your plan, didn't matter whether they terminated during the year or didn't contribute, they're part of our testing group. Okay, and we're going to see what effect that has on this test here. So the next step is to divide the company into two groups. We're going to divide the company into a highly compensated group and a non-highly compensated group. Okay, now who are the highly compensated employees? For 2020, if you were an individual who made more than, again, we're looking at this year because this is all about, what can I do this year? It's important to know who your highly compensated are this year. And it's all based on what they made in the preceding year. So anybody that grossed, this is not, what's their salary today. You had to have grossed more than $125,000 in 2019. So if your gross W-2 income in 19 was more than 125, and you're still employed in 2020, you're a highly compensated employee. In addition, any greater than 5% direct owner of the company who is working there, right? So they have to be working there. It's not just a passive investor, but greater than 5% owners are also considered highly compensated employees, and it doesn't matter what they make. If they made $50,000 a year, they're highly compensated. So it's not, you get caught by either one of these rules. Okay, it's not and. You have to be 5% owner and making more than 125. Also, certain family members of the direct owner are also going to be considered highly compensated through what we call ownership attribution. So if you're the spouse of a direct owner who actually works at the company, right? You still have to work at the company, or a child that works at the company, then you're also a highly compensated employee, and it doesn't matter what you make. You've got to make something, and be employed, but your income level doesn't matter. Also, other employees, basically, if you don't fall into these categories, these three categories, everyone else is non-highly compensated. Also, this $125,000 threshold that's applied each year can be indexed from year to year. Some years it stays the same. This 125 recently was indexed. It was in 2018, it was 120,000. So as inflation adjustments, the IRS will index the limit. So the next step is to calculate the percentage of compensation that each individual employee contributed. Again, we're doing all these calculations for you. Our systems do them. But I think it's important to understand how all this works in case your employees have questions. It'll be easier for you to answer them. So we calculate the percentage of compensation or the deferral rate for each employee. For example, if you have a person that put in $10,600 in pre-tax deferrals and $5,000 in Roth, and made $130,000, then their deferral rate is 12%. And we arrive at that. You do have to, add together both the pre-tax and the after-tax or Roth deferrals together, and then divide by the compensation to figure out what the deferral rate is. An important note too, in your payroll system, if you're computing employer matches and so forth, it's your payroll system, a lot of them automatically calculate the match based on a deferral rate. This is how you want your system calculating the deferral rate too. It's not a separate calculation, like I take my pre-tax deferrals divided by 130, and then I separately calculate my Roth at 5,000 divided by 130, and then I compute two separate matches. You need to be careful about that in your payroll system. So just double check to make sure your payroll systems are operating correctly. So once we have the deferral rates for all the individuals, we want to figure out the averages for the two groups. Okay, so as an example, we have two highly compensated. Let's say we've got a company, we've divided into two highly compensated, John and David, and we got Joe and Mike are the non-highly compensated employees. John's putting in 12%, David puts in 0, so the average, right, is 6%. Similarly, the average for the non-highly compensated in this case is 3%. So once we have the averages computed, we then are going to compare the averages of the two groups. All right. In general, there can only be a 2 percentage point spread between the two groups. There's a little caveat that if the non-highly compensated average is under 2%, you get to multiply by 2. But once it gets to 2% or higher, you add 2 percentage points. So this chart sort of shows what the maximum highly compensated average is at each non-highly compensated average rate. So for example, if your non-highlies are putting in 5%, your highlies are going to be limited to 7% of pay. So in our prior example, right, we had our two highlies averaging 6%, and the two non-highlies were at 3%, right? So that spread was greater than 2 percentage points. It was 3%, right? So here we have a failing test in our previous example. I'll just scroll back real fast. But in this one right here, right, 3 and 6, the spread is too great. That test, this ADP test fails because of that. All right, so how do we cure the testing failure? Again, there's a variety of ways, but the most popular one is to refund money back to the highly compensated employees. Another thing we can do prospectively, right? Like if we want to look at what can we do to solve this problem moving forward, we might consider some plan limits. We'll go into the details of what those are and how that works. But again, this is a participation test. So you either have to find a way to increase the participation of the non-highly compensated employees by some manner, right? Whether it's offering a matching contribution or improving a match, or you've got to bring those highly compensated employee rates down. And the way you do that is by refunding money, all right? Another method is the employer can choose to make additional QNet contributions to the plan. And these additional contributions we would count as if they were employee contributions, which again sort of boosts that average for the non-highlies up and gets it within this 2 percentage point spread. The other method is, again, prospectively, you can consider becoming a safe harbor plan, and we'll talk about what that means later. So if there are refunds, for example, this year we refunded money this year for the prior year, and to avoid a 10% excise tax penalty, those refunds need to be refunded or processed within 2.5 months after the end of 2019, which in this case was March 15th for a calendar year plan, which most of yours are. That's why, NOVA is sending a lot of reminders and kind of pressing you for your census data each year. The reason we do that, and I know it can be a little annoying for many of you, it's we don't want you to incur as an employer this 10% penalty. The other thing to keep in mind, again, just to be able to answer highly compensated employees' questions, refunds that occurred this year for the last year are actually taxable in the year distributed. So they're actually taxable for 2020. Your highly paid people don't have to go back and refile their 2019 taxes if they did that early for some reason. They're just going to get a 1099-R from your investment provider. Again, whether it's Hancock or American Funds, whoever it might be. They will issue the 1099 in January of 2021, showing the refund as being taxable in 2020, and they'll be dealing with it on their 2020 tax return next year. All right. The refunds do go back to the highly compensated employees who contributed the most in terms of dollars. And the catch-ups are not counted in this test. So, for example, any employee who is age 50 or older this year, or even last year, right, could put an additional amount into the plan. Those extra amounts, those catch-ups, last year, that dollar amount was $6,000. This year, it's $6,500. We don't actually count those in this testing, so it's on that part is in the plan for free. We don't adjust for those or refund those. So who the refunds go to? Yeah.
Sorry, we have one question. Sure. So a sibling of an HCE that works at the company is also considered an HCE?
Repeat that one more time.
So a sibling of an HCE that works at the same company is also considered an HCE?
Good question. Okay, yeah, so the answer is no. So if you're looking at family relationships, the family relationships have to be lineal. So with the exception of the spouse. So again, children, parents, but the brothers and sisters, right? When you're going across the family tree, they don't pick up the attribution of the direct owner. So if I'm the 100% owner of a company and my brother works at my company, they're not considered a highly compensated employee unless they make more than the compensation limit. Good question. All right, so in terms of refunds, who do these refunds go back to? It's kind of a complicated calculation, but the initial refund amount is actually calculated based on the highly compensated employees who contributed the highest percentage of their pay. However, so the dollar amount is determined, the total dollar amount of what will be refunded is determined based on those individuals. But then the total dollar amount is refunded back to the highly compensated who contributed the highest dollar amount, not the percentage people. So just to see how that works, if you have this scenario, three highlies, you can see John is putting in the highest dollar amount, but because Steve and David are more lower paid, highly compensated employees, if you will, right? Their percentages are much higher, right? Steve and David are putting in 11 and 12 and 10% apiece. So the refund amount of $3,500 is computed based on cutting Steve and David back, but that's not who's actually going to get the refund. The refund is going to go back to John because the IRS just mandates that the refund go back starting with the people that deferred the highest dollar amount, which in this case is John. So even though Steve and David caused the failure and the refund was computed based on their numbers, it's all going back to John. Now, why does the IRS do it this way? There's some basis for argument here. I think that they're looking at a fairness from a fairness perspective, and in their opinion, they think that the person who is able to contribute the most in terms of dollars is benefiting the most in the plan, and then they're the ones who should be, for a better term, punished, right? I don't know if I agree with that because, I mean, again, Steve and David are the ones causing the problem. You know, why shouldn't they get the refund? So it's debatable, but, you know, that's the IRS's take on it, for right or wrong. So things that can be considered to solve for this type of a problem, right? Because again, some of these lower paid highlies are creating the problem for the most highly paid individual, which is usually the owner, right? I mean, in this scenario, you can see John is probably the owner of the company. Steve and David are a couple of his highly paid employees, and he's getting punished. So if he wanted to solve this problem, what you can do is limit the deferral percentages to a fair level among the highly compensated employees. Okay, so you know, the highly who contributes $18,000 with a compensation of $120,000 has a very high deferral rate, right? Again, I'm just going over what we just discussed. This causes the failure, dramatically raises the average of the whole highly compensated group. But again, who's getting punished is the guy that put in the highest dollar amount, which may not be the highest percentage. So what can we do about this? In your legal plan documents, there is a section where if you want, and if this was a problem, this is not necessarily the problem in every plan that fails, but if you had this particular scenario, what might make sense is the owner might decide, let me put a limit on the percentage the highly paid individuals can put into the plan. Okay. What this ends up doing is it's going to not allow the two highly paid that had the highest percentage to put in as much, right? And it'll help you pass your test. And even if it doesn't pass, your failure will be much smaller. Refunds will be much smaller. So it provides for more predictable results. And also you can get some benefit from a catch-up perspective, and I'll show you how that works. Okay, so for catch-up treatment, let's say we put in a 7% plan limit into your legal plan document. So this is an option, right? Most plans don't have it, but some of our plans do. So if we limited the highlies to 7% of pay, you can see now Steve and David were putting in above 7%, right? They're putting in $12,000 and $14,000 a piece. If you limit them to 7%, they would have only been able to put in $8,400, $8,500. And the excess amount is considered a catch-up. So we're used to thinking about the catch-ups as exceeding the dollar limit. So your annual dollar limit as an individual is, let's say, $19,000. The catch-up is the extra $6,000 that you could have put in last year, right? That one we know about. But really, under the law, a catch-up is created, or you can call something a catch-up, if it exceeds any plan limit or IRS statutory limit. In this case, since we put a formal plan limit in place, the extra amount over that 7% limit can now be recharacterized as a catch-up, and it won't be refunded back to Steve or David. So they were able to put in about as much as they could before, but you solved your testing problem too. All right, so a possible change you can make to your plan document. Another thing we've discussed is, again, making additional contributions to the non-highly compensated employees. So we get to, February of this year, your 2019 test failed. You could consider, as a company, adding some money to the non-highly compensated employees. We count those percentages of the money. Let's say we put in 5% for everyone. And again, I'm just picking that out of the air, but we would take that 5%, add it to whatever their percentage is already. And again, that's how we get the average up for the non-highly compensated employees. And if we get the plan to pass this way, we don't have to refund any money back to the highly compensated employees. There are some downsides to these types of contributions, aside from just the amount of money you have to put in. They are going to be 100% vested immediately, so they're not subject to the plan vesting schedule. If your employees leave tomorrow, the ones that you're giving these to, they're going to take it all with them. Also, if your plan's top heavy, we haven't really talked about that test. You can get some benefit from a QNAC under the top heavy test as well. Again, not a popular way to solve problems, just because it can be fairly costly to throw in some more money to pass the test, but it is an option. So again, these are, what else can we do? This is a participation test, and if your non-highly compensated employees are not putting enough into the plan, it is going to greatly restrict what your highly compensated employees can contribute and how much they can benefit in your plan. And of course, these are key employees. They usually get upset at getting refunds and don't understand why they have to get some of their money back. But the way to increase some participation from your non-highlies is to improve the educational, having educational employee meetings to get them excited about being in the plan, understanding the value of saving for retirement. This is where your investment advisor can help a lot. If you haven't had any educational meetings in a while, would be a good time to have them. Of course, right now, we're right in the middle of the coronavirus crisis. I know it's a difficult time for all companies. So probably not the best time necessarily for this, but keep that in mind. Again, we've got to somehow get these non-highly compensated folks contributing to the greatest extent possible. Another way to possibly get participation up is to either add a match if you're not making a match. Again, a matching contribution is an employer contribution where you as a company are going to contribute if someone else decides to contribute to the plan. So I have an employee, you put some money in, I'll match it, and then so it's an incentive for them to contribute to the plan. You can also consider becoming an automatic enrollment plan. Automatic enrollment is, again, an optional election that you can make in your document. But what it does is, if you, let's say, switch over to an automatic enrollment plan at 3%, let's say, what happens is, as new people come into the plan, and you can also apply this to existing folks, but typically it's to your new employees. As they become eligible, you hand them enrollment materials or give them the method to enroll, whether it's online. And if they do not respond with a 0 or some other percentage, you more or less force them into the plan or automatically enroll them into the plan at whatever percentage we put in your document. Let's say it's 3%. You can also automatically increase those automatically enrolled participants. So let's say John gets into the plan at 3%. You can put in an automatic increase clause in your document that says, every December, I'm going to increase anyone who is automatically enrolled by 1%. So it kind of, again, what are we doing? We're getting those non-highly compensated employees contributing and getting those zeros out of the average. Zeros in the average are what was hurting the testing. An example of your matching formula, if you already have one, I've seen some formulas that are just not structured very well. So for example, 100% or a dollar for dollar match on the first 3% that an employee puts in is the same as 50% of the first 6%. All right. So really, the 50% of the first 6% is motivating an employee to put in 6%, which again is going to help this test. The more money the non-highlies can put in, or you can motivate them to put in, the better you're going to help this test. So if your matching formula is only motivating them to put in 3%, why not restructure it and change it a little bit? Because the cost of both of these formulas is exactly the same, right? That they cap out at a maximum of 3% employer contribution. So why not think about changing your discretionary match to a different formula? So you might want to look at what is your formula, and does it make sense to maybe change it a little bit and see if you can motivate people better. Now, if you want to get out of the ADP test altogether, okay, you can exempt yourself from that test by becoming a safe harbor plan or making a safe harbor plan election Again, this is something that does have to be done prospectively. There's no, getting beyond the 2019 year, for example, and deciding to become a safe harbor plan, although one of these rules has changed. I'll mention that in a moment. But there are two types of safe harbor plans. There's a matching variety and then what we call the safe harbor non-elective variety. And we'll go through exactly what the differences are there. But if you elect to become a safe harbor plan, you get an automatic pass on your ADP test. Okay, so if you're thinking about doing that, becoming a matching plan for a particular year, the matching variety you have to decide on for next year. There's no converting to a match mid-year this year. Okay, so the decision would need to be made by November 1st of this year, because what we're going to need to do at NOVA is we're going to need to amend your plan document. There is a notice requirement that has to go out by December 1st, and so we just need some lead time to be able to prepare the amendment, get you the notices that have to be distributed, then help you, set up some of your payroll formulas and so forth. Getting into the formulas, however, the safe harbor matching basic formula. So you have a required formula, and the very basic one is dollar for dollar on the first 3% that an employee contributes, plus another 50% on the next 2% that they contribute. So essentially, if an employee puts in at least 5% of their own pay, you're going to match them at 4% of their compensation. So again, this type of, it's a match, so it only goes to the people who are contributing. That's what a match is. If you're not going to participate, we're not going to give you any of this. All right. Now, the other variety, safe harbor non-elective contribution, is a little bit different in that it's given to anyone who's eligible, whether or not they participate. And the required formula for this type of safe harbor is you've got to give everyone who's eligible under your plan 3% of compensation. All right. The downside, again, to being a safe harbor plan is that you have to have a commitment for at least 1 year. If you drop out of it during the year, you get no benefit from it. You're subject to the testing again. Also, these safe harbor contributions have to be 100% vested. So they do go like, if you were making a regular match, a discretionary match right now, and you were thinking, oh, okay, I want to switch to safe harbor next year, you can do that. These new contributions go into a separate bucket, what we call a safe harbor bucket or a line item. Like if you're looking at your benefit statement, your old discretionary matching contributions will be under the discretionary matching line item. You start contributing, let's say at John Hancock, to a safe harbor money source, which is a separate line item. And it's that line item that's 100% vested. This doesn't mean that you have to 100% vest all the old contributions that went into your plan that were discretionary. It's just safe harbor contributions, once you start making them, have to be 100% vested. All right. Now, I don't have it in the slideshow, but there was a recent change under the Secure Act that was passed last year, where safe harbor plan, the safe harbor non-elective contribution, can actually be implemented mid-year. In fact, it can actually be implemented next year. So if you get to next year, first quarter, and you're failing the ADP test, you can actually make a safe harbor election retroactive to this year, to 1/1/2020. The percentage goes up. It goes up to 4% if you're going to do this retroactively, which can be fairly expensive, but it is an option that was not available until recently. There used to never be an election where you could change the safe harbor mid-year or even retroactively. But that's only been changed for the non-elective variety. The match still has to be decided on for future years. A third type of safe harbor is a combination of automatic enrollment and safe harbor. So the formula is a little bit cheaper, a little bit better, and you can attach a vesting schedule to it. But if you do an automatic enrollment, or what we call a qualified automatic contribution arrangement, your safe harbor formula is 100% on the first 1% that someone puts in, plus 50% on the next 5. So essentially, this formula caps out at 3.5% instead of 4%. So it's a little cheaper. But you are, part of the automatic enrollment process is, again, you're forcing people into the plan, and then you're also forced to give them a match, right? Which could become more expensive, even though the formula is cheaper. So we don't see too many of these types of plans, but some of our clients have them in terms of plan design. So what the other benefit is here, where the other contributions, the other safe harbor contributions have to be 100% vested immediately. For a QACA, you can actually attach a vesting schedule. It is limited to 2 years. So after 2 years of service, someone would then become 100% vested. But if they leave within 2 years, if you're a high turnover company, it's 0 in the first year and up to 2 years. Once they get to 2, it's all theirs. But if you have high turnover, people are leaving within a year, the company essentially recoups the money that was given. Some other options to consider, especially in this year, right? NOVA optionally provides clients, or we give you the option to do what we call mid-year testing. All right. So typically what happens is we're going to send out an email letting you know that there's an option to do mid-year testing. Again, this is not required under any of the legal testing requirements, but it gives, what we do is we take a year-to-date census and we'll annualize it for you. So we're looking at 2020 now, and you want to know, how am I doing? Am I going to fail miserably? Am I going to pass? If you're interested in that, we can take your year-to-date census, we annualize it, and then we run a mock test for this year based on these estimated amounts. And it gives you a pretty good idea of where you stand for this year, so you can maybe make a decision moving forward. Sometimes clients, we find, just like to be able to tell their Hileys, hey, expect refunds, it's not looking too good. There are additional costs to the testing. It's optional, but it does require us to do additional work. Typically, you're looking at anywhere from $500 to $1,000 to run a mid-year test. But given what's going on right now, when you see these emails around the midsummer time frame, you might consider taking us up on this offer, because this year is going to be especially different than most others, given the shutdown of the economy. I'm sure a lot of your employees, especially your non-highly compensated employees, have decided, I don't want to contribute anymore, right? Because they need to conserve as much money as possible, or they may have been furloughed. There's any number of things that have now happened that will reduce this participation rate dramatically. So whatever happened last year, if you were failing last year, it's probably going to be much worse this year. So if you want to get a feel for how bad that might be and what the estimated refunds might be, given the midpoint of the year, let us run this test and we can give you an idea. You might make a decision to become safe harbor if cash flow improves, or make some other design changes. So most of these design changes do require plan amendments. Things that we can do through mid-year testing include, sometimes there's a benefit to changing your testing method. I don't want to get into the details of some of the changes, but there are a few options that we can implement in terms of how we do the testing that can only be made mid-year. But if we don't amend your plan document in the middle of the year, right, which would be required, we can't take advantage of some of these improvements. So that's another reason to consider the mid-year testing. If you want to put in an HCE formal plan limit, again, I'm just going to, in this case, limit all my Hileys to 7% or whatever percent you pick. We do have to amend the plan document for that. And also, if we're going to make a safe harbor election for your plan, whether it's the non-elective or the matching variety, again, we do have to amend your plan. So at this point, we're basically, let's see how we're doing on time. I think we have time for some questions. Just a reminder, CPA credit is available. A link to the evaluation form will be sent after this webinar. You just return it and then we'll give you the certification in a week. I don't know if we have any additional questions.
Yes, we've had a couple questions submitted.
Okay.
I did receive a couple questions just about not only receiving a PDF copy of the slides, but also a recording. We will automatically, if you registered for today's webinar later this week, it probably won't be till Friday, but we will send you automatically the PDF of the slides and a link to the recording that we will upload to our website. It does take us about 24 to 48 hours to actually get that on our website. So you can expect those follow-up resources to be sent to you via email by Friday. A couple questions that we got in, Steve. Catch-up is not included in the ADP calculation, is that correct?
That's correct. So, you know, if you have somebody that put in, let's say 25,000, or let's see this year, what is it? It would be 26,000 because they're age 50. We're only going to count the 19,500, which is the limit this year for 2020 in the testing. So they get the catch-up basically for free. You know, that would never be refunded.
Next question. If we limit the deferral percentage for HCEs below 50 years old, if there are excess already, can we defer that for the next year, like in advance?
No. And again, the putting in an HCE limit, unless you're trying to get really fancy with it, but well, I'm assuming you're just saying HCE limit for all HCEs. It's not really that they apply to the under 50-year-olds or the over 50-year-olds. But again, because the catch-up is not counted, you know, get that out of your mind. What I'm going to be looking at, you know, if I'm thinking about an HCE limit, I want to think about, okay, I've got somebody putting in 19,500, and I'm going to now put a limit of, like, say, 4 or 5% in my plan document. Again, what am I trying to do here? I want to limit those lower paid. If you look at your testing, and your account manager can help you look at this, right? And I know those testing reports have so much information, but I know that an HCE limit is going to be good for a plan when I see a lot, you know, quite a few lower paid, highly compensated people, like people making, you know, 150, 130, something like that, you know, that have very high deferral rates. And then I see the really highly compensated people that are making like 280 or something like that, putting in the maximum dollar amount. I know that an HCE limit, when I see that kind of data in my test, is probably going to work pretty well. To answer the question, though, I mean, the limit, when it goes in, it's just going to limit that individual to that amount, and it's going to be important for you as administrators because you're the ones handling your payroll. You have to identify who the highly compensated employees are, and we can help with that, right? But again, for 2020, let's say you put this limit in now, it's anybody that made more than 125 last year. So you identify the people, you go into payroll, you cut them back to the percentage that your plan document says, or that you pick, let's say 7%. And that money at that point can never be contributed to the plan again. It's going into their checking account. They're limited to 7% of pay. You don't get to defer it to another year. There's no such thing as contributing employee deferrals or contributions to a 401k plan retroactive to the prior year, kind of like you can do in an IRA. An IRA, you can actually contribute money to the IRA in the following year and get a tax deduction for the previous year. That concept doesn't exist in a 401k plan. The money has to be deferred out of payroll. It can never get into the hands or the checking accounts of the employees. So I mean, that's what's called a cash or deferred arrangement. That's what these plans are. So you either get it in cash, in which case it can never go into the plan, or you have it deducted directly from payroll, such that you never touch it as an individual. So there's no deferment.
The next question was also kind of referring to catch-ups. I'm interested in hearing more about the option to limit the HCE contribution, which would push some of their contributions in catch-up.
Right. again, we probably need to look, if you want to give me a call or even your account manager, but, we can look at your last test to see if that's going to be a good concept for you. Again, it just depends on who's contributing what and how much people are paid. So every company can be a little bit different. If I have a company where everybody's making $280,000 or most of my highlies are at that level, and I don't have kind of a lower paid, highly compensated employee messing my test up, right? Then putting an HCE limit probably doesn't make sense in that case, but it does when you have the opposite. I got those lower paid guys causing the failure, and then I see my refunds going back to the people that put in the highest dollar amount, and it's not the same people. That's when you want to consider an HCE limit, because from a matter of fairness, I know I'm an owner and I wouldn't want to get a refund because some of my other highly compensated people are causing the problem. I'd probably want to take some action and amend my plan. But anyway, give me a call with your plan name. We can look at the data. I can get your account manager involved, and we can decide if it's a good fit for your company.
That is all the questions we've had submitted so far. Again, as Steve said, if you have any questions after the presentation or you'd like to review your most recent ADP test with your account manager, please reach out to your account manager. If you do not know who your account manager is, you can always email me at webinars@nova401k.com, and I'd be happy to get you in contact with them. Steve's contact information is also on the screen currently, and so please feel free to reach out to Steve and he can assist. As Steve mentioned earlier, there will be emails sent out, I believe in July, Steve, if I'm not correct, about mid-year testing. Whenever you get that, please reach out to your account manager. It can be a great service and really help assist with your ADP test and helping you possibly pass or mitigate those refunds to your highly compensated employees. Also, please visit our website. We do have recordings of different webinars available on our website that you can stream at your convenience. Again, we will send out a recording of this webinar on Friday to anyone that registered. So if you'd like to refer back to this information when you're looking over your ADP test, that information will be available to you. An hour after the presentation is over, so at about 3 o'clock Central, you will receive a follow-up email that will contain a survey. Please complete that survey if you would like to receive a CPA CE certificate. That will be sent via email next Wednesday. Steve, did you have any closing comments?
Yeah, I just wanted to, say thanks, and we appreciate all of you joining us today, and we, greatly appreciate your business. I know we're in uncharted territory right now during this unique emergency, but we remain committed to you as clients, and we really hope that all of you stay safe during these difficult times.
All right, well, thank you everyone for attending. Everybody have a great day.